Picture this. It's 3 a.m. and I'm staring at my trading screen, watching my account balance drop like a stone. 6 months earlier, I was convinced I'd cracked the code. I had the perfect setup, the right indicators, and what I thought was an unshakable mindset. But there I was, watching years of progress evaporate in a matter of hours. The worst part? I knew exactly what I was doing wrong, but I couldn't stop myself. If you've ever felt that sinking feeling in your stomach as a trade goes against you, if you've ever told yourself, just one more trade to break even, or if you've ever wondered why your demo account performs brilliantly while your live account seems cursed, this video is for you. I'm going to share 3 fundamental lies that nearly destroyed my trading career. These aren't just theoretical concepts. They're hard-earned lessons that cost me tens of thousands of dollars and countless sleepless nights. But more importantly, understanding these lies is what transformed me from an emotional, reactive trader into someone who can consistently navigate the markets with clarity and purpose. After 15 years in this business, trading everything from Forex to commodities, managing both my own capital and client funds, I can tell you that most traders fail not because they lack technical knowledge, but because they believe 3 specific lies about trading psychology. The first lie almost made me quit trading altogether. The second one cost me my biggest winning streak. And the third? Well, the third one is so pervasive that even experienced traders fall for it daily. But here's what I've discovered. Once you see these lies for what they are, everything changes. Your relationship with the market shifts. Your decision-making becomes cleaner. And most importantly, you stop sabotaging your own success. So grab a coffee, settle in, and let me take you on a journey through the psychological minefield that every serious trader must navigate. Lie hash 1. Trading psychology is about staying positive. When I first started trading professionally, I thought I had it all figured out. I'd spent months studying technical analysis, backtesting strategies, and reading every trading book I could get my hands on. But there was one topic that kept coming up that I completely dismissed: trading psychology. Every mentor, every book, every course mentioned it, but honestly, I thought it was fluff. New age nonsense for people who couldn't handle the heat. I remember thinking, I don't need to meditate or journal my feelings. I need better entries and tighter risk management. The first lie I believed, and the one that nearly ended my career before it really started, was that trading psychology meant staying positive and managing emotions during trades. I thought it was about taking deep breaths after losses and maintaining confidence when things got rough. I couldn't have been more wrong. Let me tell you about Jake, one of my first mentees. Brilliant guy, PhD in mathematics. Could calculate probability distributions in his head, but he kept blowing up accounts. When I asked him what was happening, he said something that sounded perfectly reasonable. The market's just being irrational. I know my analysis is correct. It's just a matter of time before it proves me right. Sound familiar? I heard myself in those words, the same justifications I'd used countless times. Instead of diving into his technical analysis, I gave him an unusual assignment. For 1 week, I told him to forget about journaling his trades. Instead, I wanted him to journal his excuses. Every single time he broke a rule, bent his strategy, or stayed in a losing trade longer than planned, he had to write down exactly what he told himself in that moment. A month later, he came back to me looking like he'd seen a ghost. His journal was filled with revelations that had nothing to do with market analysis. I couldn't let this trade beat me. I'm smarter than this. I was already down $500, so I had to make it back before the session ended. Everyone in the chat room was making money on this move. I couldn't be wrong. If I close this trade for a loss, it means I wasted the entire morning. That's when it hit both of us. Trading psychology isn't about staying calm and positive. It's about brutal self-honesty. It's about catching your brain in the act of lying to you and having the courage to call it out. Real trading psychology is recognizing that voice in your head that whispers, "This time is different," and knowing that voice has never, not once, been your friend. I learned this lesson the expensive way during my second year of trading. I had developed what I thought was a solid scalping strategy on EUR USD. For 3 weeks, it worked beautifully. Small, consistent profits. I was averaging about 2% per week, which might not sound like much, but it was sustainable and growing. Then came that fateful Thursday morning. The setup was perfect, or so I thought. Price action was textbook, volume was confirming, everything aligned. But instead of taking my usual 15 pip profit target, that little voice started talking. This is the big one. Look at that momentum. You could easily get 50 pips out of this. I ignored my rules. I held the position. When it started moving against me, instead of taking my 10 pip stop loss, the voice got louder. It's just a pullback. Your analysis was right. Don't let a little volatility shake you out. By the end of that session, I had not only given back 3 weeks of gains, but had actually dug myself into a deeper hole than when I started the month. The setup was fine. My analysis was correct. But my psychology, my inability to be honest about what was really driving my decisions, had sabotaged everything. That's when I started implementing what I now call the excuse audit. Every time I feel the urge to deviate from my plan, I ask myself 3 questions. What am I really trying to prove right now? What am I afraid of admitting? What story am I telling myself to justify this action? The answers are usually uncomfortable, but uncomfortable truths are what separate consistently profitable traders from those who blow up accounts. Here's what I want you to try this week. Don't focus on staying positive or managing stress. Instead, become a detective investigating your own thoughts. Every time you break a rule, even the smallest one, write down your internal justification. Don't judge it, don't try to fix it, just observe it. You'll start seeing patterns that have nothing to do with market analysis and everything to do with ego, fear, and the stories we tell ourselves to avoid facing uncomfortable truths. Because here's what I've learned. The market doesn't care about your feelings, your mortgage payment, or your need to be right. It simply responds to supply and demand. But your brain? Your brain cares about all those things, and it will lie to you every single day to protect your ego from the truth. Trading psychology isn't about positive thinking. It's about clear thinking. And clear thinking starts with honest thinking. Which brings me to the second lie that took me years to uncover. Lie number 2. The market is your enemy. For the first 3 years of my trading career, I had a phrase that I used almost daily. The market is out to get me today. I'd say it with complete conviction, as if somewhere in lower Manhattan, a group of institutional traders were sitting around a conference table, plotting my personal destruction. How can we mess with this guy's morning? I imagined them saying. Let's wait until he enters his position, then reverse the entire trend. This adversarial relationship with the market consumed me. Every loss was personal. Every stopped-out trade was evidence that the market was somehow rigged against retail traders like me. I spent hours on forums reading conspiracy theories about market manipulation, algorithmic trading designed to hunt stops, and institutional traders with unlimited resources pushing prices around just to mess with us little guys. The second lie I believed, and one that I see destroying traders every single day, was that the market was my enemy, something to be conquered, outsmarted, or defeated. Everything changed when I picked up Mark Douglas's Trading in the Zone. There was one line in that book that stopped me cold, and I must have read it 50 times. If you can learn to create a state of mind that is not affected by the market's behavior, the struggle will cease to exist. At first, I dismissed it as more psychology fluff, but that line kept echoing in my mind during my trading sessions. And slowly, painfully, I started to see what he meant. The market wasn't fighting me, it was reflecting me. Let me tell you about the day this really clicked. It was a Tuesday morning in September, and I'd just endured 4 consecutive days of losses. Nothing catastrophic, just sloppy execution, missed entries, and a general feeling of being out of sync with the market rhythm. I woke up that morning angry, not at the market's reaction, but at myself. And I made a decision that I now recognize as one of the most destructive mindsets a trader can have. I'm getting it all back today. I logged into my trading platform with the energy of someone going to war. My usual pre-market routine, reviewing levels, checking economic calendar, setting up my charts, was rushed and aggressive. I wasn't preparing to trade, I was preparing to fight. That day, I took more trades than I can remember. None of them matched my usual criteria. I was chasing setups that didn't exist, cutting winning trades short because I was impatient for bigger moves, and doubling down on losers because I couldn't accept being wrong again. By the market close, my account was down 18% for the week. In one day, I had undone months of disciplined growth. But here's the crucial insight. The market didn't trick me. The market didn't manipulate me. The market simply did what markets do, moved, based on the collective actions of millions of participants responding to economic data, geopolitical events, and sentiment shifts. I was the one who walked into that session trying to win an argument that doesn't exist. The market doesn't argue. It doesn't have opinions. It doesn't care about my mortgage payment or my ego, or my need to prove that I'm a successful trader. That's when I realized that revenge trading isn't about the money. It's about pride. FOMO trading isn't about missing opportunities. It's about fear of being left behind. Overtrading isn't about finding better setups. It's about anxiety and the need for constant validation. The market was holding up a mirror, and I didn't like what I saw reflected back. An insecure person using trading as a way to feel smart, successful, and in control. Once I understood this, everything shifted. Instead of viewing the market as an opponent to be defeated, I started seeing it as a partner in a dance. Sometimes I'd lead, sometimes I'd follow, but we were moving together rather than fighting each other. This shift in perspective changed how I approached every aspect of trading. My preparation became more thoughtful. My entries became more patient. My exits became more systematic. Most importantly, my losses stopped feeling personal. I remember the first trade I took after this realization. It was a simple EUR JPY, long based on a support level bounce. Clean entry, proper position sizing, predetermined stop loss. The trade moved against me immediately and stopped out for a small loss. Old me would have been frustrated, would have started looking for reasons why the market was wrong, would have probably jumped back in for revenge. But new me just looked at the chart, made a note in my journal, and moved on to the next setup. Because I finally understood. The market wasn't rejecting my analysis. The market was just being the market. My job wasn't to be right about every trade. My job was to execute my edge consistently and let probability work in my favor over time. This leads to one of the most powerful exercises I've developed over the years. I call it blind trading. Once a week, I'll dedicate one session to trading without looking at my P&L. I'll cover my account balance, hide my unrealized gains and losses, and focus solely on executing my strategy. The results are always fascinating. When I can't see whether I'm making or losing money, my decision-making becomes incredibly clear. I stick to my rules because there's no green or red number tempting me to deviate. I exit trades at my predetermined levels because there's no emotional attachment to the outcome. Try this exercise yourself. Trade one session focusing only on process, not profit. You'll be amazed at how much of your trading has been about validation rather than execution. But even after learning to work with the market rather than against it, I still fell for the third lie, one that's so subtle and so pervasive that it catches even experienced traders off guard. Lie hash 3. Mindfulness will make you a better trader. By my 5th year of trading, I thought I had figured it out. I'd learned to be honest about my motivations. I'd stopped viewing the market as an adversary. My results were improving, and I was starting to develop a reputation as a disciplined, consistent trader. But I was still missing something crucial, and it took a devastating losing streak to reveal what it was. It started during a particularly volatile period in the currency markets. Central bank policies were shifting, economic data was mixed, and my usual setups were getting chopped up by whipsaws and false breakouts. After 2 weeks of mediocre performance, I decided I needed to work on my mindset. I dove deep into trading psychology resources. I started meditating for 20 minutes each morning. I journaled extensively about my emotions and mental state. I read books about mindfulness, attended webinars about the psychology of peak performance, and even worked with a sports psychologist who specialized in helping traders. The approach seemed logical. If psychology was sabotaging my trading, then improving my psychological state should improve my results. This is the third lie I believed, and it's perhaps the most dangerous because it sounds so reasonable. Mindfulness and psychological work will make you a better trader. The truth is far more nuanced and honestly, more uncomfortable. Let me share what really happened during that period. After implementing my mindfulness routine, I felt great, calm, centered, confident. I approached the markets with what I thought was the perfect psychological state, but my results didn't improve. In fact, they got worse. I was so focused on maintaining my optimal mindset that I started ignoring obvious warning signs. I stayed in trades longer than I should have because I didn't want to react emotionally to short-term price movements. I took trades that didn't meet my criteria because I was trusting my intuition instead of following my systematic approach. Most dangerously, I started viewing any deviation from my calm, mindful state as a failure. When I felt frustrated after a loss or excited after a win, I would judge those emotions as bad trading psychology and try to suppress them. The breaking point came during what should have been a routine scalp on GBP USD. I entered a long position based on a clean support bounce, but price immediately started moving against me. My stop loss was clearly defined, but as I watched the trade deteriorate, I told myself I was being mindfully patient rather than emotionally reactive. I held that position for 3 hours, watching it move further and further into the red, convincing myself that taking the loss would be letting my emotions control me. By the time I finally closed the trade, I had turned what should have been a 15 pip loss into a 180 pip disaster. That night, I sat in my home office and wrote one line in my journal. I was so afraid of being emotional that I forgot to be rational. That's when I discovered the real truth about mindfulness in trading. It won't make you a better trader. It won't improve your win rate or increase your profits. What it will do is something far more valuable and far more uncomfortable. It will reveal who you really are when money is on the line. Mindfulness isn't about achieving some Zen-like state where you're unaffected by wins and losses. It's about developing the ability to observe your thoughts and emotions without being controlled by them. It's about recognizing when your ego is making decisions instead of your rational mind. The breakthrough came when I started using mindfulness not as a tool for feeling better, but as a tool for seeing clearly. Instead of trying to eliminate emotions from my trading, I started getting curious about them. When I felt the urge to move my stop loss, instead of immediately judging that urge as bad psychology, I would pause and ask, what is this feeling trying to tell me? What am I afraid of? What am I trying to avoid? Sometimes the answer was legitimate. I'm noticing that the volume profile has changed, and my original stop placement might not account for this new information. But more often, the answer was uncomfortable. I'm afraid of being wrong again. I can't handle another loss today. I'd rather risk a bigger loss than admit this trade isn't working. Real mindfulness in trading is the moment you catch your brain trying to lie to you and you choose not to listen. I remember one particular session where I was watching a EUR-AUD setup develop. Everything looked perfect. Trend alignment, volume confirmation, clear risk-reward ratio. But as I hovered my cursor over the buy button, I noticed something. My heart rate had increased, my breathing was shallow, and there was a tightness in my chest. Old me would have either ignored these sensations or tried to breathe them away. But mindful me got curious. Why was I feeling anxious about what appeared to be a textbook trade? After a few moments of honest self-reflection, the answer became clear. I hadn't taken a trade in 2 days because the previous setup had stopped out, and I was desperate to get back in the game. I wasn't evaluating this EUR-AUD opportunity objectively. I was seeing it through the lens of someone who needed a win to feel competent again. I closed the chart and walked away from my desk. Not because the setup was necessarily bad, but because I recognized that the person evaluating the setup wasn't the rational, disciplined trader I strive to be. It was the needy, validation-seeking part of me that should never be allowed to make trading decisions. That level of self-awareness, that ability to recognize when your ego is trying to hijack your decision-making process, that's what mindfulness in trading really is. But here's what makes this so challenging. You can't fake it. You can't use positive affirmations or breathing exercises to override genuine self-awareness. The work has to be real, and it has to be ongoing. Recently, I've been going through another rough patch. The markets have been challenging, my usual edge has been harder to find, and frankly, my results have been below my standards. It would be easy to blame external factors, algorithmic trading, unusual volatility, changing market conditions. But mindfulness has taught me to look inward first. What am I not seeing? What patterns am I repeating? What stories am I telling myself to avoid uncomfortable truths? The answer, as always, is humbling. I've been forcing trades instead of waiting for them. I've been trying to will the market to behave according to my expectations rather than adapting to what's actually happening. Mindfulness didn't prevent this mistake, but it did help me recognize it before it became catastrophic. The integration, what this all means for your trading. After 15 years of trading and 8 years of mentoring other traders, I can tell you that the difference between consistently profitable traders and those who struggle isn't technical knowledge. It's not about having better indicators or more sophisticated strategies. The difference is self-awareness. Successful traders have learned to recognize when they're lying to themselves. They've stopped viewing the market as an enemy to be conquered and started seeing it as a neutral environment that reflects their internal state. And they've discovered that psychological work isn't about feeling better, it's about seeing clearly. But here's what I want you to understand. This isn't a destination you reach, it's a practice you maintain. Even after years of working on these concepts, I still catch myself falling into old patterns. The difference is that now I catch myself earlier and I have tools for getting back on track. If you're struggling with consistency, if you find yourself making the same mistakes repeatedly, if you know what you should do but can't seem to do it when money is on the line, start here. First, become a detective of your own thoughts. Don't try to change anything yet, just observe. What stories do you tell yourself when you break your rules? What emotions drive your worst trading decisions? What needs are you trying to meet through your trading that have nothing to do with making money? Second, remember that the market is not your opponent. It's a complex system responding to countless variables, and your job is to find your place within that system, not to dominate it. When you stop taking losses personally, you free up enormous mental energy for making better decisions. Third, use mindfulness as a mirror, not a performance enhancer. The goal isn't to eliminate emotions or achieve some perfectly calm state. The goal is to see what's really driving your decisions and to choose your response rather than react automatically. This work is difficult because it requires you to confront parts of yourself that you might prefer to ignore. It's easier to blame the market, to search for better strategies, or to convince yourself that you just need more technical knowledge. But if you're serious about trading success is real, sustainable success that lasts through different market conditions and life circumstances, then this internal work isn't optional. It's the foundation upon which everything else is built. The traders who last in this business aren't the ones with the highest IQs or the most sophisticated systems. They're the ones who've learned to get out of their own way. They've mastered the art of executing their edge without interference from their ego, their fears, or their need for validation. That's the real edge in trading, not a better entry technique or a more accurate indicator, but the ability to see clearly, think rationally, and act consistently regardless of whether your last trade was a winner or loser. Because in a market full of reactive, emotional participants, the trader who can maintain clarity and discipline has an almost unfair advantage. That clarity, that discipline, that self-awareness, that's what separates the professionals from the gamblers. And that's the edge that actually lasts. If this resonates with you, if you're ready to do the internal work that separates consistently profitable traders from those who struggle, then I encourage you to subscribe to this channel. This isn't about quick fixes or magic strategies. It's about the deep, fundamental work of becoming the kind of person who can succeed in the markets over the long term. The journey isn't easy, but I promise you this, it's worth it. Because when you finally learn to trade with clarity instead of emotion, with discipline instead of hope, with rational decision-making instead of ego-driven impulses, everything changes. The market stops being your enemy and becomes your partner. Losses stop being personal failures and become simply feedback. And trading stops being an emotional roller coaster and becomes what it should be, a systematic approach to participating in one of the world's most fascinating and rewarding endeavors. That's the transformation I want for every trader watching this video. That's the standard we're building here. And that's the conversation we're having, one video at a time. Until next time, trade with clarity and may the trends be with you.